Tokenomics, it's just money rules. Okay, it tells us how many tokens there are, who gets them, what they're used for, and how fast the supply changes. Okay, if you know the basic math, you can spot red flags fast in crypto. Guys, welcome into Crypto Info, Blockchain Made Easy with your host, Frank the Crypto Tank. Please tap that like and subscribe down below, and don't forget about our Caleb link as well to hook up with crypto brokerage, supreme concierge service from Caleb and Brown. Let's define the three most important pieces first. Okay, price, supply, and market cap. Here are the core equations you'll need to use again and again when considering tokenomics and cryptocurrency. First, market cap equals price times circulating supply. Okay, price equals market cap divided by circulating supply. Fully diluted valuation, FDV, very important number, equals price times total or max supply. Okay, now that's it. With those three, you are ready to move forward with this. These are your power pieces. Let's use some quick real-world examples. Let's say a token trades at $2 and there are 200 million tokens circulating, right, for that token or coin. Market cap equals $2 times 200 million, which equals 400 million. I know this stuff's a little technical. Stick with me. I'm going to try to keep this as simple as I can. And if the total supply will eventually be 1 billion, then the FDV equals $2 times 1 billion, which equals 2 billion. Okay. Now, why do we care? Because FDV tells you the what if everything unlocks valuation. Okay. If FDV looks huge compared to the project's actual adoption, you might be paying tomorrow's price today. Let's talk supply changes, also called inflation and burns. Annual inflation rate approximately equals new tokens issued this year divided by starting circulating supply. So the net inflation rate equals new tokens issued minus tokens burned plus starting circulating supply. Now the example, real world example here, start of the year circulating supply equals 200 million, let's say. Project issues 100 million new tokens and burns 10 million. So the net new equals 100 million minus 10 million equals 90 million. Net inflation rate equals 90 million divided by 2 million, which equals 45% for the year. And it's a lot. Dilution percent equals new circulating supply minus old circulating supply divided by old circulating supply. Okay, so your ownership slice shrinks once supply grows, even if price doesn't move. That's interesting. Okay, so if you own 2 million tokens out of 200 million, you owned 1%, right? After issuance, circulating supply becomes 290 million, and your 2 million is now 0.69% if that happens, right? So same bag, just smaller slice. Now the unlock schedule, tokens often vest over time to teams, investors, or community programs, right? So big unlocks can create sell pressure, as we all know. So to keep it simple, we want to estimate daily average unlocks and compare them to average daily trading value. Daily unlock average equals tokens unlocking in a period divided by the days in the period. If that daily unlock is large versus daily trading volumes, price has to absorb, of course, a lot of new supply. So that's potential downward pressure for us. Now, next is burning. Now let's cover burning. Some networks destroy a bit of each fee that reduces supply. New supply after burn equals old supply minus burn tokens. Net inflation equals issuance minus burns. Okay, so use this in the net inflation formula that we have above, right? So if burns are steady and real usage grows, then net inflation can slow or even go negative on us. So scarcer supply helps long-term holders. Now let's handle staking rewards and real yield. APR numbers can be misleading if inflation is high, guys. APY with compounding equals 1 plus APR divided by N minus 1, where N is compounding periods per year. Okay, so real yield approximately equals 1 plus APY divided by 1 divided by the net inflation rate minus 1. So the example sounds very complicated, but if you lay it on paper, it's easy. Example, staking APR equals 8%. So monthly compounding to APY equals 8.3%. okay, in that case. Net inflation this year equals 15%. So real yield equals 1.083 divided by 1.15 minus the 1 is going to give us a minus 5.8% in this case, okay? If you put this on paper, it does make sense. It's simple enough. So you're at 8%, but after dilution, you're actually losing purchasing power, okay? Important reality check. You have to pay attention here to this stuff. Utility matters too. Simple rule of thumb, guys. No utility, no reason to hold. That's how we play it on the channel. We're not financial advisors, and it's not financial advice. That's our opinion. Utility shows up as fees, governance, collateral, or required usage for apps and payments, okay? If real activity is growing, two things can support our price. 1, demand for the token to use the network. 2, sinks like fee burns that fight inflation, okay? You can use one more simple gauge here to sanity check valuation for yourself. You can compare caps. If a payments chain like XRP sits at a certain market cap with real corridors and adoption, like it does, and new payments tokens with tiny usage already had a similar FDV, that's a warning, okay? It might be priced for perfection without the proof. Now, here's a quick buy-side sanity walkthrough. You can run in under a minute before you press that button, okay? First, what's the current market cap? Market cap, of course, equals price times circulating supply. If market cap is already huge, ask, what adoption justifies this? Second, what's the FDV? FDV, of course, as we covered earlier in the video, equals price times total supply. So if FDV is 5 minus 10 times the market cap and unlocks are soon, dilution risk is high. So look out. Third, how fast is supply changing? Another thing to consider here, right? Net inflation rate equals issuance minus burns divided by starting circulating supply, as we covered earlier, right? So high net inflation means your slice shrinks unless demand outruns supply. Fourth thing to consider, what's the unlock calendar? Look for big cliffs, okay? Estimate average daily unlocks versus daily trading volume. If unlocks are heavy, expect pressure. Number 5, what's the token's job? Fees, governance, collateral, payments, what is it? If there's no must-have utility, demand might be weak. Number 6, what price makes sense if supply grows? Use the price equation with future supply. Future price, target, whatever the target is, equals target market cap divided by future circulating supply. Okay, so for real-world example here, if you think fair value is 1.2 bill market cap in a year, right? You model future circulating supply rising from 200 million to 300 million. So future price equals 1.2 bill divided by 300 million, which gives you $4. It's simple stuff. You just have to use pen and paper sometimes. If today's price is $5, the token would have to grow adoption just to get back to that $5 once dilution hits, okay? So if today's price is $2.50, there may be room if adoption shows up. 7th, what's your real yield after dilution? Roughly compute APY from staking and then adjust for net inflation using the real world formula. Negative real yield while unlocks are heavy is a caution flag. Be careful. All right, let's anchor with 2 well-known examples. First of all, our beloved XRP. Fixed supply created at launch 100 bill. A tiny fee is burned per transaction, as we know, so supply shrinks slowly. No block rewards purposefully with XRP. Utility is cross-border payments and liquidity, as we know. The tokenomics lean on speed, finality, and tiny fees to attract institutional usage. Dilution risk from issuance is minimal. Price is more about utility growth and corridor volume over time with XRP. Now, with Algorand, the total supply is 10 billion. Distribution came from auctions, rewards, and grants. Utility is fees, governance, and participation in consensus. So holders can be selected to validate blocks with Algorand. Here you track unlock schedules and community grants against real usage. Burns are not the main driver here with Algorand. Adoption and emissions pacing are, okay? And the last piece here, keep expectations honest with one simple projection here, okay? If you believe a token can reach, say, a $5 billion market cap in 2 years, do not divide by today's supply. Divide by your future supply estimate, okay, to get your number. So projected price equals projected market cap divided by projected circulating supply. This one change alone keeps you from over-promising outcomes to yourself, okay? That's tokenomics, clear and simple for you guys. Market cap equals price times circulating supply. FDV equals price times total supply. Inflation and unlocks dilute you. Burns and real utility help us. And your target price should always use future supply, not past supply when we're calculating. Use these equations, check the unlocks, have a blast, enjoy it, grab some pen and paper and a calculator. Maybe you want a pencil with an eraser, I don't know. Make sure the token actually does something that people need. Check the tokenomics on it like we laid out for you in the video here. And if you have any questions, please tap in the comments section for us below. Please don't forget to tap that like and subscribe. And don't forget to tap our Caleb link down below for your one-stop concierge service for crypto brokerage this time around in this bull run. We appreciate you joining us on Crypto Info Blockchain Made Easy with your host, Frank the Crypto Tank. We will check you next time. We love you guys. Thanks for joining us. See ya. I know. Here you go, Luke. Okay, we good?